talking about the trade-off, right? It's been my experience at least, and I'm sure it's yours, where every time you ask for something from the lender, for whatever reason, they always want something in return. But why is that? Why are they always looking to do a tit for tat?
I mean, from my perspective, I mean, I think a lot of times is, you negotiate if you have a good set of attorneys on both sides, or, the document gets pretty heavily negotiated. So I think at some point, you're asking for something like, I mean, I think it's key. This look in the inflation scenario, right? You're seeing a lot of lenders being somewhat flexible, some aren't, but you see some being flexible and loosening their covenants. However, they're adding in liquidity covenants. They're adding excess cash flow payback requirements, things that protect them, knowing that they're giving you leeway other ways. So I think I think a lot of times the ask is to still protect them, but giving you the ability to still run your business, right? They're going to give you a waiver on not meeting your financial covenant, but they're going to require you to hold $1 million in liquidity at all times, right? And if that's something your company can do and it's an easy give. And so I think that's, it's all a protective measure. So
yeah, I mean, I part of the story is too that, as a borrower, a lot of times you're paying for their attorney.
Mm-hmm.
And so it's not really a lot of sweat off their back to go keep negotiating. But thinking about it from the client perspective is like, they have an attorney advocating for them. And a lot of times clients go in and they don't have any, they're just them, and so, you need to understand you're already kind of behind the ball if you're going into a loan negotiation. You don't have an advocate for you who understands the document and the terms and can explain them to you, so you understand what risks you're taking.
Well, I want to talk about that because I've always found this in the M&A world to be very interesting, but at the same time, one thing where a lot of buyers hate, but they also don't understand, is when you're buying a company, in this case, you're borrowing the money. When the bank is hiring an attorney or an attorney is working on behalf of the bank, they're actually passing that cost on to you in addition to whatever you're paying him in interest, right?
Interest origination.
And so you're basically negotiating against yourself. I mean, they're using your dollars to negotiate against you. So how do you make this process as efficient as possible without giving away the farm? And like you said, the bank's trying to avoid leakage, but at the same time, you're trying to make sure you protect your control of the company, right? Because it's not just a credit agreement that we're trying to negotiate here. We're trying to keep control of our company. We don't want the banks coming in. Mm-hmm. And you guys have seen this with some of these, some of the language in there. They come in and they got you. They're telling you when you can make distributions, who you could pay, who you cannot pay. How do you protect yourself and at the same time make this process efficient to keep your costs down? And I think, Jack, you and I've talked about this before. Is it get an attorney involved right away, or what's the process here? How do we become more efficient?
Well, I mean, I would say, as someone who is kind of representing a business in a situation like that, and then kind of turning to specialists to help out. I mean, you get somebody involved that has negotiated a lot of these and knows where you can win points and lose points, instead of somebody who wouldn't know where to push and pull. I mean, you could put like a finance document in front of me and I could probably figure out some things, but I don't know where necessarily the specialized pain points are of the bank and what they're going to budge on and not budge on. And if I'm pushed on something they're never going to budge on, I'm just wasting everybody's time, right? So having somebody like Matt that I can bring in to help with that makes it a lot more efficient. But something I wanted to ask you, Matt, is at what point is the right time to bring you in? I'm sure it's you always get in. I'm sure, and a lot of times you always get brought later than you want to, and sometimes that's the client kind of trying to feel out whether they're willing to spend the fees because they don't know how serious the other side is. But when do you feel is the right time to bring you in into a deal that involves some type of financing?
Yeah, so I mean, it's all dependent on the customer. I mean, the borrower, the bank knows that how price sensitive they are. And I mean, the ideal time would be term sheet stage, right? The time that the term sheet's going to be negotiated. And that's on if representing the lender or the borrower, right? Because you want to make sure, just like an LOI and an M&A transaction, those terms are going to set the pace for the whole entire deal. You know, you're going to go back to that. I mean, there's also always going to be, you know, a term sheet's not going to lay out all the definitions, all the covenants. They're going to say, you know, they're going to make reference to general covenants and typical transactions of this size, something of that nature, right? So those can all be negotiated after the fact. But I mean, key business points, a lot of the times it's advantageous to get them in the term sheet. You know, if you know you're going to make an acquisition in 3 months, right? You don't want to have the credit agreement provide 10 hurdles for you to jump over. You want you want to put those hurdles in front of the bank in the term sheet phase and say, you know, we're going to make this acquisition in 3 months. These are the financials of the company. So let's just get it pre-approved. So in 3 months down the line, the acquisition is going through, you're negotiating the purchase agreement. We don't have to deal with hurdles at the bank, right? So I think the term sheet phase on both sides is always ideal. Most of the time, the way it works is if it's not an existing client from the borrower side, you get brought in after the term sheet. The bank does their due diligence. Sometimes they'll come to the attorneys for specific points if the borrower's asking for something out of the normal. If the borrower does have counsel and they're asking for those items, they'll come a lender's counsel. And then, obviously as a borrower's counsel, I would go in and you'd ask for the specific items, but then you get brought out, when it's time to document the loan. And that's typically when you get brought in, and then you're kind of one step behind at that point because a lot of the main points have already been negotiated, in the term sheet. So ideally it would be at the term sheet phase would be the time to be brought in. And then, not to jump off this, but going back to yours about, costs associated with it. I think it's always the banks it'll regulate its attorney at some point. It's a relationship business. So they don't want their attorney, even though that it's going to be paid by the borrower, they don't want them to go out and charge exorbitant fees if they're going to have to pass it on to their borrower, who's then got to, have enough money to pay them back. So it's kind of a ever revolving circle of, but I mean, then again, you have to strike a good deal that's in the middle, that's something that works for both sides. And so sometimes it just works that way. And unfortunately, the borrower has to pick up that tab 90% of the time.